Have you ever wondered what actually happens when someone says, I bought shares of Apple or the stock market crashed today? Where do these shares come from? Who keeps track of millions of buyers and sellers every single day? And why do stock prices change every second? The answer to all of these questions starts with one place: the stock exchange. Think of it as a giant digital marketplace where companies raise money, investors build wealth, and billions of dollars change hands every day. But here's the interesting part. A stock exchange isn't just a place where people buy and sell stocks. It's one of the most important pillars of the global economy. In today's video, you'll learn what a stock exchange is, why it exists, how it works, why companies list on it, why investors use it, the world's biggest stock exchanges, and how beginners can start investing safely. By the end of this video, you'll understand the stock exchange in the simplest way possible, even if you've never invested before. So let's get started. Chapter 1. What is a stock exchange? A stock exchange is an organized marketplace where investors buy and sell shares of publicly listed companies. Imagine a farmer's market. Farmers bring fruits and vegetables. Customers come to buy them. The market ensures everyone follows the rules. Now replace fruits with company shares. Replace farmers with companies and investors. That's exactly what a stock exchange does. Instead of vegetables, people trade ownership in businesses. When you buy one share of a company, you're purchasing a tiny ownership stake in that business. If the company grows successfully, the value of your investment can increase. If the company performs poorly, the value may decrease. The stock exchange provides a secure and transparent platform where these transactions happen fairly. Without a stock exchange, buying and selling company shares would be extremely difficult because there would be no trusted system connecting buyers and sellers. Chapter 2. Why was the stock exchange created? Businesses need money to grow. Imagine a company wants to build a new factory, open stores in new cities, hire more employees, develop new products, expand internationally. All of this requires capital. Instead of borrowing huge amounts from banks, companies can raise money from the public. They do this by selling shares. Investors buy those shares. The company receives fresh capital. In return, investors become part owners. This benefits both sides. The company gets funds for growth. Investors get the opportunity to share in future profits. This system fuels innovation, creates jobs, and supports economic growth. Without stock exchanges, many of today's biggest companies might never have expanded into global businesses. Chapter 3. What is a public company? Not every business is listed on a stock exchange. Most businesses are private. Ownership stays with the founders or a small group of investors. A public company is different. Its ownership is divided into millions of shares that anyone can buy through the stock exchange. For example, imagine a company is worth $100 million. It divides ownership into 100 million shares. Each share represents a tiny portion of the company. If you buy one share, you become one of its owners. Large investors may own millions of shares. Small investors may own only a few. But everyone owns a part of the same business. Chapter 4. How does a stock exchange work? Let's understand the process step by step. Step 1. A company decides to list on the stock exchange. This process is called an initial public offering or IPO. During the IPO, the company sells shares to the public for the first time. Step 2. Investors buy these shares. Some buy because they believe the company will grow. Others invest for dividends. Some traders buy and sell shares frequently to profit from short-term price movements. Step 3. Once the IPO is complete, investors trade shares with each other. Notice something important. After the IPO, when you buy a share, you're usually buying it from another investor, not directly from the company. The stock exchange simply provides the marketplace where this happens. Step 4. Prices constantly change. If more people want to buy than sell, prices rise. If more people want to sell than buy, prices fall. This basic principle is called supply and demand. It drives every stock market around the world. Chapter 5. Who participates in a stock exchange? Many different participants keep the market running smoothly. Companies. They raise capital for business expansion. Retail investors. These are everyday people investing their own money. Many use investment apps or brokerage accounts. Institutional investors. These include mutual funds, pension funds, insurance companies, banks, hedge funds. They often manage billions of dollars. Brokers, investors usually cannot trade directly on the exchange. Instead, they use licensed brokers who execute trades on their behalf. Market makers. They continuously provide buy and sell prices. This helps ensure there is always enough liquidity for trading. Regulators, government authorities monitor the market. They work to prevent fraud, insider trading, and market manipulation. Their goal is to protect investors and maintain confidence in the financial system. Chapter 6. Why do investors buy stocks? People invest for different reasons. Capital growth. If the company's value increases, the share price may rise. Investors can sell later for a profit. Dividends. Some companies distribute part of their profits to shareholders. These payments are called dividends. They provide regular income for investors. Long-term wealth creation. Historically, stock markets have helped many investors build wealth over decades. While markets fluctuate in the short term, long-term investing has often rewarded patient investors. Chapter 7. Why stock exchanges matter. Stock exchanges play a much bigger role than simply buying and selling shares. They help businesses raise capital, support innovation, create employment, encourage investment, improve transparency, increase economic growth, build investor confidence. A healthy stock market often reflects a healthy economy. Although markets may rise and fall, they remain one of the strongest drivers of economic development worldwide. Chapter 8. Famous stock exchanges around the world. Here are some of the world's largest stock exchanges. New York Stock Exchange, NYSE, the largest stock exchange in the world. Many of the world's biggest companies trade here. NASDAQ, known for technology companies. Many global tech giants are listed on NASDAQ. London Stock Exchange, one of the oldest financial markets in the world. Tokyo Stock Exchange, Japan's primary stock market and one of Asia's largest. Shanghai Stock Exchange, a major financial hub in China. National Stock Exchange, NSE, India's largest stock exchange by trading volume. Bombay Stock Exchange, BSE, Asia's oldest stock exchange, established in 1875. Today, both NSE and BSE play a vital role in India's financial markets. Chapter 9. Common myths about the stock exchange. Let's clear up a few common misconceptions. Myth 1. Only rich people invest. Reality. Today, many brokers allow people to start investing with relatively small amounts. Myth 2. The stock market is gambling. Reality. Random speculation can resemble gambling, but disciplined investing based on research and long-term goals is very different. Myth 3. You need to be a finance expert. Reality is anyone can learn the basics with time, patience, and continuous education. Myth 4. Stocks always go up. Reality, markets can rise and fall. Every investment carries risk, so diversification and long-term thinking are important. Chapter 10. Beginner tips before investing. If you're just getting started, keep these tips in mind. Learn the basics before investing. Never invest money you may need soon. Diversify your investments instead of putting everything into one stock. Think long-term rather than chasing quick profits. Research companies before investing. Stay calm during market ups and downs. Continue learning as you gain experience. Successful investing is usually a marathon, not a sprint. Let's quickly recap. A stock exchange is a regulated marketplace where investors buy and sell shares of publicly listed companies. It helps businesses raise capital, gives investors opportunities to build wealth, and supports the growth of the global economy. Whether you're investing for retirement, saving for future goals, or simply learning about finance, understanding the stock exchange is one of the first and most important steps. Every experienced investor started as a beginner, and learning the fundamentals is where that journey begins. If you found this video helpful, give it a thumbs up and share it with someone who's just starting to learn about investing. Subscribe to BNR Universe and turn on notifications so you never miss our beginner-friendly finance guides. In our next video, we'll explain what is the difference between NSE and BSE. In simple terms, helping you understand how India's two major stock exchanges compare. Until then, keep learning, keep growing, and invest wisely. Thanks for watching.